Hello, this is Justin from Auto Trading Academy. So in this video we're going to look at how are your stop losses being hunted in the retail forex trading market, and does this actually occur, and who is responsible for this. So there's a lot of traders out there who are very frustrated in this sort of area and topic, and they wonder, what the hell is going on. They place a trade and they put their stop losses in a logical area like support and resistance lines, and then they basically get stopped out. The market takes them out and then moves in the same direction as it should have, and they would have made a nice profit if they hadn't got stopped out. So that's essentially stop loss sort of hunting, and there's a lot of people there frustrated of getting their stop losses taken out, and the market moving actually in the right direction. So how does this work, and who's responsible for it? Well, a lot of people think it's the broker who's sort of doing this to you, trading against you, and manipulating the price and so on. In the matter of fact, in the real forex market, it's certainly not your broker who's doing this. It is possible with dealing desk brokers to do this in a certain fashion. So again, it does depend on the broker you're with, so that is quite important. But in general, in the real forex market, and the reason I say real, because if you are trading with a dealing desk or a market making broker, which is essentially how all of MetaTrader 4 started out in 2005, with basically all brokers were dealing desks making the market for you, then you're basically always trading against your broker, and he's taking the other side and making that market for you by taking on risk and creating that price feed for you essentially. So he has full control of the price feed, and that's open to a lot of abuse basically, and there are certain plugins out there that can basically allow you to manipulate and basically make profit off your clients. So if you just Google MT4 virtual dealer plugin, you'll see what sort of things dealing desk or market maker brokers can get up to. So that's the reason why I say the real market, because if you are trading with a dealing desk or a market making broker, you're not actually trading with the real market, you're trading against your broker because he's taking the other side of your trades. But that's a whole sort of different topic and beyond the scope of this video. So essentially it is possible that your broker is doing this against you if you're trading with a dealing desk broker or a market making broker, which is how basically the retail forex market began. So most of them were basically that type. Of course, this doesn't usually happen. It's usually with the scammy brokers or brokers that don't have any regulation. If you are trading with a dealing desk broker which has strong regulation like in the UK, then it's going to be very unlikely that even a dealing desk is doing such things, because they're open to very, very big fines and investigations and so on. So effectively, it's very unlikely if you have a good broker that the broker is doing this against you in terms of a dealing desk or market making broker. If you are with a scammy one that's got some regulation in some island somewhere, then it is likely that can happen for you. So basically you have to choose a broker in terms of a market perspective. So just to sort of sum it up in the broker sort of scope field, with a dealing desk market maker broker, it is certainly possible to manipulate prices and run your stops. Again, not very likely with good regulated brokers. But if you're trading with an ECN STP type broker, then it's certainly definitely not your broker who's doing this. The reason is that if you are trading with a STP ECN broker, they pass your trades through actually to the real market, and they don't take on any risk. They're just an agent, an intermediary. So with dealing desks, it's different. You're trading against them. With STP ECN brokers, they're passing it through and they're charging you a commission. So it's in their interest, for you to make money. So why would they even bother running your stops? It doesn't make sense. So there is no incentive even to do this from an STP-ECN broker, whereas from a dealing desk, there certainly is incentive, because all of your losses are their profits. So essentially that's how it is from the incentives perspective. But is it really that is it really basically brokers who are responsible for this? So as I said, in the real market, it's certainly not. and the ones who are actually responsible for this are large, basically funds, institutional players who have, a lot of cash, and they're basically trading huge amounts, 100 lots, 1,000 lots, and so on. And the reason this stop loss hunting actually happens is because they need to get into the market with a big position, and they want to get a good price. That's essentially the reason why stop loss hunting happens. Because if you think about it, if you're a large fund and let's say you want to enter the market here, so the market's going up and it's gonna, let's say because of fundamentals in that sort of time period, the market's going to continue on going up, and let's say you're a big player and you want to go in long pound dollar, and if what's going to happen, if you're going to go in long somewhere here, or let's say here, what's going to happen is basically the price will slip and you'll get massive slippage in the real market and you'll get really bad price. So that's effectively what's going to happen if you're trading massive amounts as an institutional player. To sort of really sum it up, you just basically get massive slippage because there's not enough liquidity. There's not enough liquidity at that price point for the amount that you want to buy, and essentially what's happening is you're getting slipped and you're going to get really bad price, which is basically natural slippage in the STPCN sort of market. It's part of the market structure. Slippage is a very natural phenomena. So how do you do it? How does a large player enter the market? How does he guarantee himself all of that liquidity? So he basically needs a lot of sell orders, pound USD sell orders, to be able to enter big at that price point. And at that price point it doesn't exist. So what does he do? Well, the only area in sort of here where there's basically lots of liquidity, lots of sell orders for your buy orders basically is around here. And that's because there's going to be a lot of stop losses here, because the market's been tested. Once it went sort of through a bit, but then it got tested against twice, and then the third time. So the market's got tested. So a lot of traders, a lot of people will be basically putting their stop losses somewhere around here, whether it's here or here. But this is going to be a very concentrated area of stop losses, and essentially these stop losses of the buy orders are basically the liquidity that you need for essentially your buy order, because you need the sell orders, which are basically the stops of all of these other guys. So you need these stops basically, which is the sell orders for you. So how do you do it? So what you do basically, you look at the market depth, which is what the institutional players have. They have very good obviously information of the market depth, of the structure of different lot sizes, different prices, where the limit orders are, the stops are, and so on, especially if you're a liquidity provider in one of the marketplaces for Forex. So what happens is the market drops, just like in the usual stop loss hunting scenario. The market drops, takes out all your stops, and goes back up and carries on going up. So essentially that's a classic case sort of scenario. And basically what's happened here is all of these funds, or let's say a big player, decided, okay, I need to get into the market, I need to buy 2,000 lots or 20,000 lots. Okay, so what I know there's a lot of sell orders here, so I'm going to run the price. He calculates how much it's going to cost to run the price here, hit all of these, basically enter the liquidity sort of area, and then basically execute his own real large order, buy order, and then the market goes back up. So that's essentially, it's a two-step process. You calculate the cost of driving the market down, and you can do this quite precisely because you can see the liquidity of the market depth and the available orders and so on. So very much for them it's much easier to do this than for any of us. And then they basically execute their trade here, where they've got a much better price, and they enter here with their, let's say, 1,000 or 2,000 lots or whatever, and basically the price goes all the way back up and keeps on going up. So that's how a large fund enters, and this is one of the reasons, you know, your stops are certainly being hunted, just not by brokers, but actually by big players. And of course, you know, most people, that's where they place their stops. And of course, a lot of these institutional players have access to information of where all of these stop losses are. So it's a pretty sort of risky decision, obviously, to move the market in that way, because you do need hundreds and hundreds of, you know, dollars to, you know, participate in this sort of move. Probably, you know, hundreds of millions of dollars to move the market in that way. So it is, you know, a risky move, of course, and you know, it can pay off big time in this sort of two-step process. So that's effectively how it sort of works. So stop loss hunting certainly does occur, and it's just basically not by what most people think, that it's their broker cracking them away and pocketing their pips, but it's actually you know, big institutional players that need a good price to enter into a, you know, a currency position. But the only way to get that good price without the massive slippage is to look for an area where there's a lot of liquidity, and that area of that huge liquidity is basically where all of your stop losses or orders are, in that respect. So I hope you guys like this video. I hope this sort of clears it up for you, how how basically you're getting buggered by by the market sometimes. So the logical thing to do here is just to place your stops in a different area, place them much further away than you usually would. And actually a lot of very good traders, you know, do place very big stop losses, particularly for this reason. So hope you guys liked the video, and I'll see you in another one.